Greetings, it's Gordon again. We're now moving on to the inheritance tax aspects of trusts. I've got to start with a little bit of terminology. We've seen that for income tax purposes there are rules for interest in possession trusts and there are rules for discretionary trusts. Up till April 2006, that used to be true for inheritance tax as well. I'm not going to bother going through what the rules were because that is deep, dark history. However, what you do need to understand is that from April 2006 onwards, which is the rules that you're going to need to know about now, it's not quite as simple a split as just looking at the two different types of trusts. Because if a trust is created while the settlor is alive, and it doesn't matter whether it's interest in possession or discretionary, we now, for inheritance tax purposes, call it a relevant property trust. Likewise, a discretionary trust created on the death of settlor is also a relevant property trust, and we've got a set of rules that apply to relevant property trusts that I'll go through in just a second. The different type of trust is an interest in possession trust created on the death of a settlor. That is what they call an IPD, an immediate post-death interest, and the rules for that are completely different to the rules for a relevant property trust. But let's start with the relevant property trust and three situations that you need to be able to deal with. Firstly, the creation of the trust. Well, if it's done while the settlor's alive, that is your classic chargeable lifetime transfer. The settlor will pay tax at 20 or 25% depending on who's paying the inheritance tax. If it's created on the death of the settlor, then the assets are simply in the death estate. The fact they're going into trust really doesn't make any difference. The tax implications are the same as if they were absolutely bequeathed to a beneficiary. Then, for the privilege of having a relevant property trust, every 10 years the trustees have to pay something called a principal charge. Now, in simple terms, this is just 6% of the market value of the assets, so the assets have to be revalued every 10 years, and there's a charge at 6% on the value of the assets. Now, this is a bit of a simplification, because in some situations you might have a bit of nil band available. However, the work required to find out how much means that for exam purposes it's barely worth the bother, and to be honest, if people try and do it, they get it wrong anyway. So that's the bit you shouldn't be attempting. Just stick with 6% of the market value of the assets, and that's your principal charge. Capital distributions, I'm going to have a similar simplification. In reality, there are rules for distributions in the first 10 years of the trust, and then there are rules for later distributions. And to be honest, they're horrible. They're absolutely horrible. Very few people can do them accurately, certainly not under exam time pressure. So what we need is a working simplification. You need to know that where there's a capital distribution of assets, there is an exit charge payable. And the simple version is the exit charge is 6% times the market value of the assets distributed. This isn't 100% precise, but it's good enough. If you want to go a little bit more precise, still not spot on, but not bad, you would then multiply that by n over 40, where n is the number of complete quarters since either the trust was created, if it's in the first 10 years of the trust, or since the last principal charge, if the trust's been running more than 10 years. So you're basically saying proportionately how far into the 10 years of a principal charge have the assets remained into the trust. With an IPD, in immediate post-death interest, the key thing, the one thing really you need to remember is that first line. The life tenant of the trust is deemed to own the trust assets. This is only for inheritance tax purposes. Doesn't apply to any other tax, but for IHT, the life tenant is deemed to own the assets. Now remember, an IPD is always created on the death of a settlor. So in principle, the assets are just taxed in the death estate. And the fact they're going into trust, on the face of it, doesn't matter. The only time it would be an issue is if the life tenant of the trust was the spouse of the deceased, because in that case it's a gift to your spouse, and that is therefore exempt inheritance tax, all coming back from that initial line, life tenant deemed to own assets. Now, with an IPD, you don't get principal charges and you don't get exit charges. However, when the life tenant dies, you do get an unpleasant shock because the life tenant was deemed to own the assets. So when the life tenant dies, those trust assets have got to be valued. They're included in the death of the life tenant. Technically, they go under a separate heading from your free estate. They go in as settled property. But fundamentally, they're part of the death estate of the life tenant, and therefore inheritance tax of 40% will be paid on them. In the relatively unlikely event that the life tenant gives away their life interest while they're still alive, that is simply a pet. So if the life tenant lives 7 years, no tax. If the life tenant dies within 7 years, you've got a pet that becomes chargeable.